Welcome to TechGolly Weekend News.
Howard Lutnick, Trump's nominee for Commerce Secretary, explores $2 billion crypto lending project with Tether.
U.S. President-elect Donald Trump's nominee for Commerce Secretary, Howard Lutnick, is reportedly planning a significant expansion into the cryptocurrency space. Lutnick, CEO of Cantor Fitzgerald, is discussing launching a $2 billion lending initiative with Tether, the world's largest stablecoin operator. According to a Bloomberg News report on Sunday, the project aims to provide loans in U.S. dollars to clients using Bitcoin as collateral. Sources familiar with the matter said Cantor Fitzgerald is seeking financial support from Tether to fund this ambitious venture, which has the potential to grow to tens of billions of dollars. In a statement, Tether indicated that it plans to use profits accumulated over recent years to explore new investment opportunities. Tether and Cantor Fitzgerald already have a lucrative financial relationship. The firm reportedly holds billions of dollars in U.S. Treasury securities backing Tether's stablecoin, earning Cantor Fitzgerald tens of millions annually. Stablecoins like Tether are digital tokens designed to maintain a consistent value by being pegged to traditional fiat currencies, such as the U.S. dollar or euro. Tether's involvement in this project underscores the increasing role of stablecoins in broader financial ecosystems. Lutnick's nomination to lead the U.S. Commerce Department aligns with his advocacy for cryptocurrency adoption. Should he assume the position, Lutnick would oversee critical areas, including trade policy, tariffs, and economic development, while managing agencies like the U.S. Census Bureau and investment promotion offices. This collaboration between Lutnick and Tether marks a convergence of traditional finance and cryptocurrency, emphasizing how digital assets are reshaping the global financial landscape. The proposed lending initiative could pave the way for increased institutional engagement in cryptocurrency markets while raising questions about regulatory oversight and the potential influence of private crypto enterprises on public policy.
Chinese EV stocks surge as China and EU near tariff resolution.
Chinese electric vehicle stocks rallied in Hong Kong trading on Monday amid reports of significant progress in resolving tariff disputes between China and the European Union. According to Bernd Lang, chair of the European Parliament's Trade Committee, Brussels and Beijing are close to an agreement that could eliminate tariffs on Chinese EV imports into the EU. Speaking to German broadcaster NTV, Lang revealed that the proposed solution might involve China setting a minimum price for EVs sold in the EU. This would eliminate the distortion of competition through unfair subsidies, which is why the tariffs were originally introduced, Lang stated without providing additional details. The news fueled gains in EV stocks. Shares of NIO Incorporated rose nearly 4.45% or 1.60 to 37 Hong Kong dollars and 55 cents, while Geely Automobile Holdings Limited saw a 1.25% or 0.16 increase to 13 Hong Kong dollars. Li Auto climbed 1.75% or 1.50 to 87.05, with BAIC Motor Corp Limited rose 1.75% or 0.04 to 2 Hong Kong dollars and 33 cents and BYD Company advancing by 0.39% or 1.00 to 259 Hong Kong dollars and 60 cents. The tariff issue has been a contentious point in EU-China relations. Earlier this year, the EU imposed up to 45.3% tariffs on Chinese-made EVs, citing unfair subsidies that distorted competition. Lang's comments follow discussions between Chinese President Xi Jinping and German Chancellor Olaf Scholz during the G20 summit in Rio de Janeiro. President Xi highlighted the global significance of resolving EV tariffs and reiterated China's commitment to constructive dialogue. Although neither the European Commission nor China's Ministry of Commerce has officially confirmed the developments, both sides have indicated that technical progress has been made. Reports suggest that discussions are ongoing, with key details of the potential agreement still under wraps. If finalized, the resolution could reshape the competitive landscape of the European EV market. By committing to a minimum price, China could address EU concerns about undercutting local manufacturers while maintaining access to a vital market. Market watchers are optimistic that the deal will bolster trade relations and reduce tensions between the two economic powerhouses. Investors in Chinese EV firms closely monitor the situation, as eliminating tariffs could significantly boost sales in the lucrative European market.
Tariff threats from U.S. President-elect Trump spark economic concerns in North America.
The Bank of Canada and Mexican President Claudia Sheinbaum have expressed concerns over U.S. President-elect Donald Trump's proposed 25% tariff on imports from Canada and Mexico, set to take effect on January 20th. Trump announced the measure as a response to issues such as drug trafficking, particularly fentanyl, and migrant crossings. This move could have significant economic implications for all three countries, potentially violating the United States-Mexico-Canada agreement signed in 2020. The Bank of Canada acknowledged the potential fallout of Trump's tariff proposal, with Deputy Governor Rhys Mendez stating that such measures could adversely affect Canadian and U.S. economies. Mendez emphasized the need to closely monitor the situation and incorporate policy specifics into future economic forecasts. The Bank of Canada is scheduled to release updated projections on January 29th. Canada has been experiencing an economic recovery, with inflation stabilizing at 2% after spiking to 8.1% in mid-2022. Mendez noted that the Bank of Canada's recent rate cuts aim to foster confidence among consumers and businesses. However, Trump's tariffs could disrupt this progress, potentially reigniting inflation and hindering growth. Mexican President Claudia Sheinbaum criticized the tariffs, warning that they would lead to inflation, job losses, and strained trade relations. Mexico's automotive sector, which accounts for 35% of its manufactured exports, could be particularly hard hit, given that 79% of its vehicles are exported to the U.S. Sheinbaum highlighted efforts by her administration to address U.S. concerns, such as combating fentanyl trafficking and reducing migrant crossings. However, she pointed out the reciprocal challenge of smuggling firearms into Mexico from the U.S. Sheinbaum has called for dialogue and cooperation to resolve shared issues and prevent economic harm. The Mexican peso weakened by 1.3% following the announcement, reflecting investor concerns about the potential impact of Trump's policies. Analysts noted that Mexico's export-dependent economy is particularly vulnerable, with its position as the U.S.'s top trade partner at stake. Economists warn of broader risks to Latin American markets, which could face significant challenges if tariffs escalate.
OpenAI employees offered $1.5 billion share sale to SoftBank in tender offer.
According to two sources familiar with the development, OpenAI, the artificial intelligence powerhouse behind ChatGPT, allows its employees to sell approximately $1.5 billion worth of shares to Japan's SoftBank Group in a tender offer. This move marks a significant step for SoftBank as it deepens its investment in the AI sector. SoftBank's billionaire CEO, Masayoshi Son, has consistently shown interest in increasing his stake in OpenAI following the conglomerate's previous funding round. OpenAI, backed by Microsoft, recently raised $500 million from SoftBank as part of a $6.6 billion funding round in October. This brought the company's valuation to an impressive $157 billion, underscoring its rapid growth and significant role in advancing artificial intelligence technologies. The tender offer allows OpenAI employees to sell their shares at the same valuation as the previous funding round. According to a source, employees have until December 24th to participate. Another source revealed that the funding will be managed through SoftBank's Vision Fund too. OpenAI and SoftBank declined to comment on the matter. Masayoshi Son has been actively bolstering SoftBank's presence in the AI space. In addition to investing in OpenAI, SoftBank has acquired stakes in other AI-driven companies, such as chip startup Graphcore. Son recently hinted at saving resources for his next big move, without elaborating on specific plans. OpenAI's meteoric rise has attracted global attention. Since launching its flagship product, ChatGPT, the company has amassed a staggering 250 million weekly active users, further solidifying its position as a leader in the AI industry. The new investment aligns with SoftBank's broader strategy to capture the expanding opportunities in AI and related technologies. By deepening its partnership with OpenAI, SoftBank aims to ride the wave of AI-driven innovation and solidify its foothold in the rapidly evolving tech landscape.
Pony AI raises $260 million in U.S. IPO, valued at $4.55 billion, amid rising interest in autonomous driving.
Pony AI, a leading Chinese robotaxi startup, announced on Wednesday that it raised $260 million in its U.S. initial public offering, valuing the company at approximately $4.55 billion. This milestone marks Pony AI as the latest Chinese firm to capitalize on renewed investor confidence in U.S. markets, particularly within the competitive autonomous driving sector. The IPO involved the sale of 20 million American depositary shares at $13 each. Additionally, Pony AI secured $153.4 million through a concurrent private placement. Despite this successful fundraising, the company's valuation has dropped from its $8.5 billion peak 2 years ago. This IPO is a litmus test for investor sentiment toward Chinese companies amidst ongoing U.S.-China tensions. As the two nations vie for dominance in autonomous driving technology, OpenAI's performance may shape future investments in similar ventures. The regulatory environment for Chinese firms listing in the US has also shown improvement. Beijing's resolution of a prolonged audit dispute with the US accounting watchdog in late 2022 has paved the way for smoother listings. Other Chinese tech companies, including EV maker Zeekr and self-driving tech firm WeRide, went public in the US earlier this year. However, OpenAI faces significant challenges. Public skepticism about autonomous vehicles, concerns over data privacy, and stiff competition from global players like Tesla complicate the landscape. Tesla, for example, has announced plans to introduce driverless ride-hailing services in California and Texas in 2025, intensifying the race for market dominance. OpenAI has indicated that its US operations will remain limited for now. Given ongoing safety and reliability hurdles, analysts predict widespread adoption of robot access may still take years. In this context, China appears to be progressing faster than the US in approving trials for autonomous vehicles. Despite being backed by Toyota Motors, OpenAI remains unprofitable as it focuses on scaling its operations and advancing its technology. The company is set to begin trading on the Nasdaq later on Wednesday, and its performance will be closely watched as a barometer for the autonomous driving industry.
FCC approves T-Mobile and Starlink's satellite-to-phone service for remote connectivity.
The Federal Communications Commission has granted conditional approval to T-Mobile and Starlink for their groundbreaking satellite-to-phone service, initially announced in 2022. This collaboration aims to provide T-Mobile subscribers with connectivity in areas beyond the reach of conventional cell networks using Starlink satellite infrastructure. The Federal Communications Commission's approval allows the deployment of up to 7,500 second-generation Starlink satellites to support the service. However, the Commission has deferred its decision to increase the satellite's radio emission power, which is necessary for enabling real-time voice and video calls. For now, the service will focus on messaging capabilities, with plans to expand into voice and data services over time. T-Mobile CEO Mike Sievert has highlighted the project's ambitious vision of universal connectivity. Users can stay connected with a clear sky view, even in remote areas like oceans. This innovation could be critical for maintaining contact with loved ones and requesting assistance during emergencies, especially in locations where traditional cell towers cannot reach. The Federal Communications Commission chairperson Jessica Rosenworcel emphasized the importance of fostering partnerships between terrestrial mobile carriers and satellite operators. She stated, "The FCC is actively promoting competition in the space economy by supporting more partnerships between terrestrial mobile carriers and satellite operators to deliver on a single network future that will put an end to mobile dead zones." The Satellite-to-Phone initiative represents a new era for mobile communication, made possible by the Federal Communications Commission's regulatory framework established in March 2023. These regulations ensure that satellite services coexist harmoniously with terrestrial 4G and 5G networks. However, not all stakeholders are fully on board. AT&T, which is developing its own satellite services in collaboration with AST SpaceMobile, has raised concerns about potential interference with existing wireless services. AT&T plans to demonstrate the non-interfering nature of its satellite technology. T-Mobile and Starlink achieved a significant milestone by successfully sending and receiving text messages using this technology in January. Additionally, the Federal Communications Commission permitted satellite texting in hurricane-affected areas earlier this year, showcasing the service's potential to provide critical connectivity during natural disasters. With regulatory approval, T-Mobile and Starlink are poised to redefine mobile connectivity worldwide, especially in remote and underserved regions.
Bluesky faces growing pains as verification challenges spark concerns.
Bluesky, the burgeoning social media platform, is experiencing rapid growth but grappling with significant verification challenges. As new users flood the platform, impersonators and scammers have taken advantage of Bluesky's unconventional approach to verification, which relies on custom domain names rather than traditional checkmarks or badges. A study by Alexios Mantsarlis, director of the Security Trust and Safety Initiative at Cornell Tech, revealed that 44% of the 100 most followed accounts on Bluesky have at least one impersonator. These doppelganger accounts often mimic original profiles down to bios and profile pictures, highlighting Bluesky's vulnerabilities. Instead of proactively verifying accounts, Bluesky encourages users to adopt custom domain handles to self-verify. For example, organizations like the New York Times and Bloomberg use their official domains as handles. While this system ensures only domain owners can access the verification, it's a labor-intensive process involving technical DNS adjustments, making it inaccessible for many users. Further complicating matters, Old handles become available for others to claim once a new custom domain is adopted, increasing the risk of impersonation. Some users have devised creative workarounds to address the issue. Investigative journalist Hunter Walker has manually verified over 330 high-profile accounts, including politicians, celebrities, and journalists. Walker often uses official email communications or representatives to confirm identities, even creating a system that adds emojis to verified accounts for better visibility. However, Walker acknowledges the limitations of his efforts, urging communities and Bluesky to develop broader verification systems. Impersonation issues are exacerbated by the lack of visible verification markers, such as badges, and scammers' potential misuse of lookalike domains. Vice President Kamala Harris, for instance, reportedly had 20 impersonator accounts despite not having an official presence on Bluesky. Bluesky has acknowledged the challenges and pledged to improve its moderation and verification processes. Emily Liu, a spokesperson for Bluesky, stated that the company has quadrupled its moderation team and is exploring visual verification signals for a better user experience. CEO Jay Graber hinted at the possibility of introducing a system with multiple verification providers in the future. Despite these challenges, Bluesky's open-source nature presents opportunities for users and organizations to shape the platform's trust and identity systems collaboratively. As Walker emphasized, this transitional phase is critical for addressing identity and trust concerns about Bluesky.
Australia enacts social media ban for under 16s, the global first.
Australia has passed a groundbreaking law banning social media use for children under 16, setting a global precedent for regulating big tech. The law, which targets platforms such as Instagram, Facebook, and TikTok, imposes fines of up to 49.5 million Australian dollars or $32 million for non-compliance. A trial of enforcement methods will begin in January, with the full ban taking effect in 2025. The Social Media Minimum Age Bill introduces one of the strictest regulations globally, mandating that platforms prevent underage access without exceptions. While countries like France and the US states have implemented parental consent-based restrictions, Australia's law is absolute, sparking debates on its implications. The law marks a win for Prime Minister Anthony Albanese, whose government faces declining approval before the 2025 election. Despite opposition from privacy advocates and child rights groups, the measure gained public support, with 77% of Australians backing the ban, according to polls. The law emerged after a year-long parliamentary inquiry that highlighted the impact of social media on youth mental health, including testimonies from parents of children harmed by online bullying. Critics, including youth advocacy groups and the Australian Human Rights Commission, argue the ban could alienate vulnerable teens, such as LGBTQIA and migrant youth, by cutting off access to online support networks. Privacy advocates warn it could pave the way for heightened data collection and state surveillance. In response, lawmakers introduced amendments requiring platforms to offer alternatives to identity document uploads for age verification. However, concerns persist about the lack of detailed guidance on enforcement. Tech companies, including Meta and TikTok, have yet to comment but previously called for a delay until after the enforcement trials. Critics like Digital Industry Group Australia argue the law's rushed implementation leaves platforms unclear about compliance requirements. Meanwhile, parents and advocates emphasize the need for intervention to combat cyberbullying and mental health crises. However, younger Australians remain skeptical, fearing the ban could drive them to riskier online spaces while failing to address underlying issues.
Record holiday spending expected despite inflation concerns and economic strain.
According to the National Retail Federation, Americans are forecasted to spend at record levels this holiday season, averaging nearly $1,000 per person over November and December. This anticipated 3.8% increase in retail spending comes despite lingering concerns about inflation and cost of living pressures. The optimism in holiday spending contrasts sharply with voter sentiment about the economy. In exit polls, 75% of voters expressed experiencing moderate or severe hardship due to inflation, and nearly half felt financially worse off than 4 years ago. Although inflation has cooled significantly since its July 2022 peak of 9.1%, food prices remain substantially higher than pre-pandemic levels. The Farm Bureau reported that the cost of a traditional Thanksgiving meal, while 5% lower than last year, is still 19% higher than in 2019. MasterCard's Spending Pulse predicts a 3.2% rise in online and in-store holiday spending, indicating consumer resilience. This is supported by a robust job market where wage growth has outpaced inflation over the past 2 years. Retailers like Walmart remain optimistic, raising their sales forecasts, while others like Target caution that stretched budgets may lead to more price-conscious shopping. Target has announced plans for additional discounts to compete with rivals. Travel is also expected to boom this holiday season, with the Transportation Security Administration forecasting record numbers. More than 18 million passengers are expected to pass through U.S. airports during Thanksgiving, and AAA anticipates that 80 million Americans will travel by car. Falling gas prices, nearing a national average of $3 per gallon, are expected to ease travel costs further. Despite these positive indicators, challenges persist. Consumers are still grappling with the cumulative impacts of inflation, and retailers face pressure to meet demand while addressing price sensitivity. The shortened holiday shopping window between Thanksgiving and Christmas adds another complexity for businesses aiming to capture seasonal sales. Catherine Cullen of the NRF highlighted the importance of holiday spending, stating, "The winter holidays are a treasured time for Americans, and they are prioritizing spending on family this season. Retailers are preparing with earlier deals and ample inventory to cater to demand."
French inflation slows amid waning confidence, supporting case for ECB rate cuts.
France's inflation rate rose to 1.7% in November 2024, marking a slight acceleration from previous months but falling short of analysts' expectations, according to data released by the statistics agency INSEE on Friday. The figure remains well below the European Central Bank's target of 2%, reinforcing arguments for further interest rate reductions in the Eurozone. Economists surveyed by Bloomberg had anticipated inflation rising to 1.8% this month, marking the second consecutive month of acceleration. Despite the uptick, the rate still signals subdued inflationary pressures in the Eurozone's second-largest economy. The ECB is expected to announce its fourth interest rate cut of the year during its final monetary policy meeting in December. While some officials have hinted at a more aggressive half-point cut due to weaker economic data, most prefer a gradual approach to monetary easing. Inflation trends across the Eurozone remain mixed. Spain recorded an expected rise, while Germany's inflation rate remained steady, contrary to predictions of an increase. The Eurozone's aggregate inflation rate, set to be released later on Friday, is projected to reach 2.3%, slightly above the ECB's target. In France, November's inflation was driven by a 2.5% increase in services prices, which are closely monitored for signs of economic activity. Energy costs continue to decline but at a slower pace, reflecting the challenges in balancing inflationary pressures and economic growth. Adding to economic concerns, consumer spending in France fell by 0.4% in October, the first decline since June. Households spent less on manufactured goods and energy, defying economists' expectations of no change. The drop in spending underscores weakening consumer sentiment, which fell to its lowest level since June amidst ongoing political uncertainty. France's political landscape remains volatile, with budgetary disputes triggering sell-offs in financial markets. On Thursday, the yield on 10-year French bonds matched Greece's for the first time, highlighting investor concerns. Despite these challenges, France's economy grew by 0.4% in the third quarter of 2024, according to INSEE, providing a silver lining amidst broader economic and political difficulties.